Welcome to HDFC Bank Money Talk. Money Talk is a series of videos to help you understand the world of finance and economics in a simplified manner. Abheek Barua, Chief Economist, HDFC Bank, will present the first video of this series, Twin Impact of Persistent Inflation and Weak Monsoon.
Let's talk about the one thing that's been consistently grabbing newspaper headlines, the topmost concern for all households in the country. It is inflation or price rise that is currently running at about 10% today. What has been driving this inflation? The biggest contributor to inflation happens to be food. Food inflation is running at over 10%, close to 11%. The other big contributor to inflation has been fuel prices. Petrol prices have been hiked a number of times. One bit of good news that I want to share with you is globally, because economies are slowing down, oil prices have come off sharply. So the possibility of petrol prices coming down in India, or perhaps at least stabilizing, is very, very real. The other bit which is encouraging is the fact that manufacturing inflation is stabilizing. After that little bit of good news, let's get to the bad news. There's been a severe rainfall deficit this year. Monsoons have been patchy in most parts of the country. Having said that, things are improving. The rainfall deficit is much less in the east, south and west than it is in the north. Let's take the most adverse scenario where monsoons remain weak. There will obviously be an impact on food prices and they will move up further. The particularly vulnerable ones are things like oilseeds, pulses, fruits and vegetables. Even staples like rice will see an increase in prices. Fortunately, the government holds reasonably large buffer stocks of things like rice, so it will release that in the market and there could be some relief. The situation is not as good for things like pulses and oilseeds, so be prepared for a rise in prices there. What does high inflation imply for a bank and its customers? Interest rates, if you think about it carefully enough, basically compensate for inflation. So if inflation continues to be high, interest rates are unlikely to go down. This would mean different things for borrowers from a bank and depositors in the bank. Borrowers who take all sorts of loans cannot unfortunately look forward to a reduction in interest rates if inflation remains high. The saving grace is that the same borrower might also be a depositor. So if inflation doesn't come down, deposit rates will also remain stable. From that perspective, while he loses on his borrowing costs, his loans to the bank remain at a stable rate.